Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, September 17th, 5:01 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the big show, the weekend edition of the Revere Market Insight video, where we take a look back at the prior week and take a peek ahead at what is important to know going into next week, and of course update the world famous 21 over 21 leaders list. Let's get right into it. State of the market. We're in a short-term pullback. However, leaders are holding up just fine. It's mostly the indexes that are getting hit, and mostly the big cap portion of the indexes. The G5 proxy. This is a proxy of 5 growth index ETFs that we track, has been outperforming pretty much most of September. And when this does well, our portfolios do well because we traffic in the same type of stocks that are made up of those. In those indexes, when the market is right and the winds are blowing in the right direction, they tend to outperform the market, and that's what we've been seeing for most of September. So let's check over here to the trend gauge. You can see leaders staying in an uptrend, as we mentioned. Short term, we're neutral with the arrow. There was some improvement in the arrow over the last couple of days, but back to pointing toward bearish yesterday as we reclaimed the 21 on the Nasdaq 100 on Wednesday and Thursday, but broke back below it today. So we'll take a review of all the indexes here shortly, and you can see where we stand relative to their moving averages. Medium term, still showing bullish, but there are some cracks in that. We'll also review that when we go over the indexes. You can see the yellow arrow pointing toward neutral. Long term, we're fine versus the 200-day moving average, and we have been since July of last year. So what happened today? Mid and large indexes are weak, leaders mixed. Take a look at the G5 and the 5 major indexes here. You can see the G5 positive on the day. It held up, had a bad day on Monday, but held up relative to the indexes very well Tuesday through Friday, including today. You can see that finishing positive at plus 0.25, led by ARK-K today. And we'll take a look at that. I read unconfirmed that all of the top 10 holdings in ARK-K were positive on the day. And I'm going to verify that over the weekend. I know Tesla did finish green, and that's a top 10 holding. S&P 500 down 0.9%, Nasdaq 100 down 1.2, Dow down 0.5%, midcaps down 0.7, Russell 2000 positive by 0.2%. Let's take a look into the indexes now, and then we'll move on to some charts of the leading stocks and some lagging stocks. But first, if you want to get a look at who's running Revere here, we would love to speak with you about active management and the keys to avoiding large losses in your portfolios. We've got the major indexes teetering on the 50-day intermediate term moving average right now. If that breaks, that's a significant level that we monitor. Should we get down below the 200-day moving average, that is absolutely the line in the sand. Should we get there, we will be mostly out of the market by that point, and under the 200-day moving average, the long term, that is where risk picks up in a major way in your portfolio. And if you have funds with an advisor and you're approaching retirement and they have no plans to take defensive action, if you start breaking down, if the market starts breaking down and you start heading lower quickly in your retirement plan, you better give that a second thought. If nothing else, get a second opinion. Split your funds between somebody that's doing the pie chart pinhead nonsense and somebody that's going to take an active approach to save your account, because the sequence of returns on the last couple of years going into retirement is so critical to whether or not you achieve success during your retirement years. You worked to save a nest egg. It'd be just a damn shame if you gave a big chunk of it back on the last couple of years heading into retirement because of the concept of sequence of returns. That means that the market on average returns 8%, but it's not 8% every year. And there are long-term, the markets trend higher. They have throughout history. at least the U.S. markets definitely. But that long term is made up of a bunch of brutal intermediate and short terms. For example, COVID, S&P 500 dropped 34% in 5.5 weeks. Were you worried? If you weren't worried, you're probably not listening to this video in the first place. If you know somebody that did get worried, please forward this video to them so we can discuss to them some actions that can be taken if that happens again, because it absolutely will happen again. Give us a shout if you'd like to discuss this. You can email any of us, Dan, Tim, Hunter, Mural, Alex, or Don at revereasset.com, or maybe the easiest thing is to call 855-REAL-WEALTH. That's 855-732-5932. Chart time now. We're going to check the indexes. Why do we check the indexes first? Because 75% of all stocks track what's going on with the overall market. And then additionally, another 49% of a stock's action has to do with what sector and industry group they're in. So we're first looking at what the direction is of the general market across 3 time frames: short-term, intermediate term, and long-term. Then we look at what sectors are leading and lagging. We avoid the laggards and we look at the best stocks in the leading sectors. And when the market starts to turn south, we lock in our gains, cut losses quickly, and get out of the way of the freight train that can be a harsh downtrend. And you can see here, so let's take a look at these 3 time frames. Short term, we're talking about the green line, that's the 21-day exponential moving average. Intermediate term is the red line, that's the 50-day moving average. Down here's the black line, that's the 200-day moving average. Big berth between the 50-day moving average and the 200-day moving average right now, about 8% to the downside. So you can see here, we broke the 21-day, that's the green line short term, late last week, struggled to get above it all week, could not get above it, and now we finished just barely, just 3 points below the S&P 500's 50-day moving average. So this is the first close below the 50-day moving average since June of this past year, and that was just a one-day affair before we bounced back up and made another up leg. Now, I can't say that that's going to happen. I can't say that it's not going to happen. I know September is a seasonally weak time for stocks. That's played out, certainly. There's also a saying that says sell Rosh Hashanah and buy Yom Kippur. Yom Kippur was yesterday, so that's a little bit late. And we don't guess. We're just going by what's going on with the indexes and the leading stocks. Leading stocks are holding up fine. Very clear deterioration in the indexes, and we'll take action if this deterioration continues. But as of right now, we've had a higher high and a higher low going all the way back to throughout the entire year. You can see this red line. Every time we visited it, we bounced back above it. So the key level, not only breaking the 50-day moving average, would be this spike low here on 819. If we break below that, that would break the definition of an uptrend, which would be higher highs and higher lows across an intermediate term time frame. So if we break below that, then we've made a lower low, and by definition that breaks the uptrend. These are the types of things that we pay attention to. And if we continue to make this, these leading stocks that are holding up fine are going to get taken down if the indexes continue to get taken down. So we're keeping a very close eye at this tenuous position that the indexes are in. So there's the S&P 500. Let's take a look at the Nasdaq 100. Leads up, leads down. Here it had a nice 1, 2, 3, 4 week move up. Now it's gone sideways. You can see relative to the moving averages, this is still the leader. We had a close just right on the 21-day moving average on Tuesday. We put a short on when we broke below this because it was the first break below it in a couple of weeks. But the next 2 days, we got right back above it. We took the short off. Now we broke it again today. That's not a positive. That should have held. So this is definitely something we're paying attention to because the Nasdaq 100 is tech heavy, and a lot of the stocks that we buy are tech stocks. So right now, first close, and it's a weekly close below the 21-day moving average. This index is still above the 50-day moving average. That's this critical red line here. We still got 1.1% to go to the downside. When should that happen? Apple broke its 50-day moving average today. Apple is a big bellwether in the market, not an overly expensive stock. It's one that indexes rely on a lot, and it's a go-to stock. And if it's lagging, that's a kind of a flag for what's going on with the overall market. First weekly close below the 50-day moving average on that. We'll take a look at that chart shortly. So there's your Nasdaq 100. Let's go to the Dow Jones Industrial Average. We'll look at the DIA. By the way, the S&P 500, the SPY went ex-dividend today. So if you compare, let's look at SPY. Compare SPY to its 50-day moving average. You can see that it is 0.3% below it. Add $1.40 onto the price of the SPY. That's how much it went ex-dividend today, and you would see that takes you back up to just barely below the 50-day moving average. So a chart of the SPY and a chart of the S&P 500 are going to be slightly out of sync. This happens once a quarter, and then it kind of alleviates itself, but I do want to point that out. Okay, DIA, I believe this might have also gone ex-dividend today, but I can't say for sure. But I can say for sure that the 21-day has crossed below the 50-day moving average, and this is firmly below the 50-day moving average and made a lower low going all the way back to the last correction that this made at the end of July. Very, very much serious weakness here. We did have a little kick up in relative strength Monday and also today. Didn't lose as much as the indexes, but you can see where the trend is. You can see that this has been trending lower. If we get full defensive mode, meaning if these growth indexes that we track start selling off, you will see relative strength in the Dow because money will flow out of them and into safer or perceived to be safer sectors, and those sectors are weighted heavier in the Dow Jones Industrial Average, and it tends to outperform when tech is selling off. So that's something we're keeping an eye on. But for now, we're trending below the 50-day moving average, and the 21-day moving average has broken through the 50-day moving average on the Dow Jones Industrial Average. Let's go to mid caps, MDY. I believe this also went ex-div today, but this was holding up fine last week and the week before at the top of its range, but gave it up over the last 2 weeks, breaking the 50-day. The 21-day again has rolled over, and we're below the 50-day and the 21 on mid cap. So this is not looking so good either. From a relative strength standpoint, just going sideways over the last week and a half. And now finally IWM, which did show some extreme relative strength over the last couple of days. You can see here, this has been all over the place, really, because there's been a lot of bifurcation between what banks and what oils are doing and what some of the small growth leaders are doing. You can see, again, we tried to make a run 2 weeks ago, but that paused. We rolled over. We're above the 50, but below the 21, so we're trapped between the 50 and the 21. So now we've got the Nasdaq 100 and small caps above their 50-day moving average. The other three indexes below the 50, all indexes below the 21, although IWM is right there on the cusp of it. So further weakness on this will be going bearish on our short-term trend gauge. But let's see how this plays out the first couple of days of next week. Now, what I'd like to do is break this up into what's going on with the growth portion and the value portion, because IWO is one of the 5 indexes that we track in our G5 of growth index. So here's the growth part. You can see the relative strength strong over the last 3 days, and this actually above all 3 moving averages as they're clumped up here right around this 300 level. So that's a plus for small cap growth. Now let's look at IWN. This is the value portion of it. Trending lower, but still not in bad shape, but right on the 50 and below the 21. So this looks more like what's actually going on with the index itself, the full index, the IWM, the small cap index. So see what happens early next week to the small caps and the growth indexes. And let's take a look now at all of those growth indexes. IWO, I already did discuss this. Next one is FFTY. This is the IBD growth. IBD 50 growth ETF, and this looks pretty good. Up near all-time highs, not much of a pullback today. Certainly looking good. You can see the relative strength here over the last 4 or 5 weeks, and this is one of the reasons why we're still in a bunch of the growth stocks that we've bought. We've got stopped out of a couple of them, but for the most part, they're acting just fine. The FFTY certainly supports that. QQQJ is the next one. This is a mid-cap growth Nasdaq 100. Consolidating over the last 2 weeks above the 50-day moving average, right on the 21. This is a healthy consolidation. This is really just putting in a handle on this long flat base that you see here, but very critical that it holds this 34 level. PDP is the fourth one. And I know this is kind of thin, and you can also substitute MTUM for this, but this also looks pretty good. Look at the relative strength over the last 4 days, consistent with what we've seen in the G5, just a pullback, and nothing wrong here. And now finally ARKK, which has been the laggard, but not today, up over 2% and reclaiming the 8, the 21, and the 50-day moving average here. If you want to do some research, go to the ARK Funds website, see what they're holding, and see what happened to those stocks today. Like I said, I did read that all the top 10 were green. And this is the weakest of the 5 that we use, but certainly the strongest today. So that's the G5. We looked at all of the indexes. Let's take a look now at the 21 over 21 list, and we're going to start with what got booted out this week. 3 stocks kicked out. LC, we bought this on this gap up, made some decent gains, not great gains in it. It broke out again, but it gave up this breakout level above 30, and then the 21 has rolled over and closed just about right on it. Actually, no, 0.4% below it. And we have Upstart in the 21 over 21 list, which is pretty much in the same group. So don't need 2 of the same group. So LC out. ALB, chemical stock tied to lithium. 2 rough days here, Friday and Monday. Tried to get back above it. Weakness the last 2 days. This is really just consolidating. It looks okay, but you got to be above the 21 to be in the 21 club. That's simple. And then finally, FTNT. This stock had been in the 21 list since the beginning of March. Look at this big ride up here since never closing a week below the 21-day moving average. A couple of pokes below it, but never closing the week below. And from the beginning of March, riding all the way higher. So like from 180 to 300, and I owned this exactly 0 times during this because we were just involved with other things. A harsh shakeout here after earnings, and then finally rolling over this week on Monday. Some heavy selling. Notice some big red bars here starting to pop up, which really didn't see prior. And then the 21-day rolled over, and it could not get back above it, very similar to what you see going on with the indexes. So saying goodbye to FTNT after a very nice, and we're actually holding the record of a run inside the 21 over 21 list. So those are the 3 that got punted out. Let's take a look at what got added, as well as the full list here. We've got 10 industry groups, 10 sectors, 10 major sectors, 18 different industry groups. And if it's flagged, we own it. That's how we roll at Revere here. I don't just put out this list for the heck of it. This is where we traffic in the stocks that we own. We eat our own cooking. We've got a lot of our own personal funds in these portfolios, and we're following the discipline that buys leading stocks and leading sectors in a bull market and gets out of the way. And let's start off with the 3 that were added this week, and we own them all. Unity Software, nice move up on earnings here with volume, pulled back right to the 21. Now then started working its way higher. A little bit of resistance here around this 127 level when it finally got back above it and then tested the lows. The 21-day was above that 127 level, and now it's holding it. Look at the volume patterns. The blue bars higher than the pink bars. This looks fantastic and continues to trend higher. We've got a position in this, as I said. Everything that's flagged over here we own. Second one is Lulu. We got stopped out on Lulu as it headed into earnings with these big selling days that it had, but just blew out earnings, gapped up, pulled back, bounced off the ADMA, and then after these two of the three below average days, it consolidated, bounced off the 8. Volume came in over the last 2 days. We took a 2%, added another 2%, so we've got 4% size in Lulu, and a very clear stop out area in this. It should hold the low of 2 days ago. PWR, this is one that we just added today. So they made an acquisition on 9/2. Normally, the acquiring company, because it dilutes the company, they gap down. This one gapped up, which meant Wall Street loved the acquisition. Look at the volume these 2 days. Sideways for a week and a half, moved out 2 days ago, but volume wasn't overwhelming. A little pullback yesterday, and we got into this today as it pulled back to the top of this little this week and a half consolidation here. So we've got made 3 different buys on this today. We've got 5% size on PWR. Note the volume, note the relative strength, also at a new high. AFRM, this has really been quite a wild ride. Big gap up here on a partnership with Amazon. So speculators initially bought it, then it sold off, came down to the 8. This was speculators saying, oh, nice, partnership with Amazon. What does it really mean? And then they announced earnings and they broke down what it really meant, and then it moved up another 34%. This is where we got into it. It pulled back a little bit, added some to it twice this week. So we took a 2% size, added another percent twice this week. So we got a 4% size on this, using this ADMA to control most of the position. Next up, DOCS. Again, something we own. This has been, from a relative strength standpoint, not doing too much over the last 2 weeks, but that's good. It's consolidating because it had this big move up on earnings. Going sideways, holding the 21. As long as it holds the 21, we'll hold on to it. Ambarella, really like the looks of this. Huge gap up, 1,270%, up 27% on an earnings report. Day 2 higher high, it's always good. Day 3 higher high, it's even better. Very tight consolidation, not giving back any of it. In fact, it's very rare to see after a big gap up day that candles the following days don't come back into the bar of the gap up day, and that shows incredible strength. Another volume day up above this breakout area, and then it continues to chug higher. People want to buy this stock. It's that simple. Look at the relative strength, no breaks since the gap up day on earnings. We've got this is our biggest position right now. Love the way it's acting. At least half of the position will be controlled by this 8 EMA. Big leaders trend up along the 8 EMA, very similar to the 10 simple moving average, and then we've got the 21 coming up to this week. It'll pass the high of that gap up day, which is additional support, and it looks great. Not to say that couldn't all come apart next week. It certainly could, but for now it's doing what we want it to do. Nvidia has been relaxing over the last couple of weeks, really going nowhere. From a relative strength standpoint, just going sideways, sitting right on the 21 now. That's about as far down as we want to see this go. DraftKings, weakness in the market led to some weakness in the stock, but it is holding the 21 like a champ. You can see this is a handle showing here now on this big cup and handle. Pretty good looking base. Let's see what happens with DraftKings. They continue to grow sales and form additional partnerships. Devon Energy, one of the best looking energy stocks, putting in a little handle here, had a nice day on Wednesday, consolidated it despite a pullback in oil over the last couple days. One of the best looking oil charts that you'll see. Zim, kicking myself for this one, several buy points. I just passed on them, and it just continues to ride. This is an example of a leader riding higher along the 8 EMA. I love to see that. In mode, this one has been brutal from a shakeout standpoint this week. Monday, couldn't find any news on it, down on massive volume, 10%. And then look what it did the last 4 days, just completely reclaiming that big gap down day and making all-time highs. Upstart, another stock making a very strong move after a big gap up on earnings. AMBA's acting a lot like this one right now. You see the day 2 higher high, the day 3 higher high, a little bit of sideways action into the 8 EMA, goes higher, come back to the 8 again, goes higher, come back to the 8 again, makes higher highs. So again, we're using the 8 to control a lot of this. We've trimmed some of this, don't have a whole lot of it left. Ideally, I'd like to see this rest, pull back to the 21 where I can reload again. Dexcom continues to act great since it's this is another textbook example of what we look for with these big earnings gaps up. In this case, didn't do very well afterwards. Should have bounced off the 8. It didn't. This is actually where I bought it, but I sized it for on a break below the 21. Came down to the 21. We added to it a couple times here, taken a little bit off the table, but it bounced off the 21 and made higher highs. Note the relative strength line. Very consistent characteristics on everything that we're holding here. Datadog, gap up. This has been choppy, but a big gap up on big volume. Then that's what we look for. Pull back, bounce off the 8, higher highs and higher lows. Undercut this week. We got stopped out of some of this when it undercut the 21. So we still have a half position in it, and then boom, to new highs along with the relative strength line. Zoom info. Big gap up on earnings. Then they had a secondary. This really messed with the stock for a while. New highs, pulled back hard to the 21, and then there was a big seller at 63 for a couple of weeks. Got back above that, 63, formed the top of this flat base, pulled back to 63 3 times and held, which at that point coincided with the 21-day moving average. Took off from there. We bought it this week when it made that little move off of the 21, tried to make a new high today. Note relative strength line at all-time highs along with price. When you have relative strength at new high and a price at new high, if you sell out of it, it's your own fault, or you're being emotional, or you just decided to lock profits in. But these are the types of things that you want to own in a market. Zscaler. Really some rough action into earnings and after earnings. Shakeout, got back above the 21 now. Let's see if it holds the 21. I've got my eye to re-enter this. I got shaken out of it on really one of the worst sells that I've made in a while down here when it just poked below the 21. And then it made this nice move up without me, but Zscaler continues to look good. Costco continues to ride the 21 higher. A couple bounces off the 21 this week. Avantor announced a secondary, but it really didn't affect the price. It's riding the 8 EMA higher in the medical sector. Net, we continue to hold this. I got shaken out of some of it on Monday, and it proceeded to make higher highs. We've got like 30-40% profits in the piece of it that we still have back from when we bought it earlier this year, a couple weeks or months back. Wish I still had that, but yeah, I did get shaken out of it. I set stops and I stick to them when they happen, and it happens. But those funds went into stocks like Affirm and that are doing the job that they would be doing if they were still in net. So net made some new highs, pulled back today. This looks really good. CMG, another one, got stopped out into earnings, some selling into earnings, big gap up, should have bought it right away, didn't buy it right away, finally got into it. Actually, no, we're not in this at all now. Note the break below the 21, but the reclaim of the 21 over the last couple of days, despite some softness in the market, is a nice sign. And this is really a nice 4-week consolidation here after the gap up. And finally, AMT sitting right on the 21, has undercut several times, but we'd like the diversification, this being a REIT, that it gives us, and that's your 21 over 21 list. Portfolio changes this week. I talked about when we added to the QQQ short position. We put it in on this break below. It was in here when we broke below the 21. Got right back above the 21 the next day, took it off, and now we're right at that level again, just a little bit below where we sold it. So maybe putting this back on next week if we continue to see weaknesses. We added to Affirm now a trade that just absolutely didn't work out this week. Steels and really all commodity stocks had a very strong day on Wednesday. We bought 6% XME, and then the dollar, UUP. This is very important. The dollar had 2 extremely strong days the last 2 days, and this has just absolutely wreaked havoc with not only the markets, but also anything commodity related. Strong dollar equals weak commodities. And got stopped out on XME for our max loss on this. Closed right on the 50 yesterday, broke below there early today, and got rid of it today. So that's gone. XME, that was one that certainly did not work for us. I talked about how we added to AMBA, initiated ZI, added to Affirm, Lulu, and bought power today. Stopped out of a little bit of Apple for some clients that we bought, new money that came in that we bought recently. Made new highs, but it broke below the 50-day moving average. So this is one of the points I wanted to make about Apple. We're just not going to hold for new clients a losing position, even if it is Apple, because if this sets up again, we can get back into it. So book a small loss on this on the weekly close below the 50-day for some clients, and that's going to wrap it. As always, like to hear from you. I'm on Twitter at Vandenbord. Email don@revereasset.com. The phone 855-REAL-WEALTH. Again, I want to echo the importance of the dollar here, because while we talked a couple of weeks ago, Tim showed how it was at the +3 ATR, the dollar, during our podcast. And I said, well, last time we were here, I think it was back here when we were extended this, and coming off of an extended area with the dollar with a big sell-off is very bullish for stocks. And we had a nice run in stocks in April and May. Let's take a look at the S&P 500. You can see here is the April and May run, a little bit of softness at the end of May. Let's go back to UUP, and you can see this peak here on the 19th of August coincides with a peak in the S&P 500 here on the 19th. Starts to pull back. Not a lot of give back in the indexes then, but look now how over the last 2 weeks how the indexes have come off while the dollar has gone higher over the last 2 weeks. It's definitely something to pay attention to, because when something has been range bound and it breaks out, it impacts, and it's just inter-asset correlation. It impacts other asset classes. A big one to note with this would be the TNX, the 10-year bond, how when this broke out in mid-February, how growth stocks just absolutely got decimated during this period where the 10-year was going higher from mid-February into the end of March. You can also see here we're in a range-bound area on the 10-year, and if this breaks above this 1380 area, that's also going to be a negative towards stocks, in my opinion. It should be if the correlation stands. If it is, if it doesn't, it doesn't. But it's definitely something we're keeping our eye on, is how bonds and the U.S. dollar act and the relationship to stocks. So that's definitely going to wrap it. So wrapping up the week, ending 9/17, this is Don Vandenbord telling it like it is. Thanks for listening. Have a great weekend.